Question 1. Assessment of a Direct Participation Program (DPP) in California requires a principal to evaluate the offering. Which of the following approaches best demonstrates adherence to regulatory requirements and professional best practices for performing due diligence on such a program? Option A. Independently scrutinizing the offering documents, verifying sponsor claims, assessing the program's economic viability and associated risks, and evaluating the sponsor's track record and reputation. Option B. Relying on the due diligence report provided by another member firm that has already reviewed the program without conducting an independent assessment. Option C. Accepting the sponsor's representations and marketing materials as accurate and complete, assuming they have been prepared with due care. Option D. Prioritizing the potential for significant commissions and fees generated by the DPP when determining the depth and focus of the due diligence investigation. Correct answer is A. Independently scrutinizing the offering documents, verifying sponsor claims, assessing the program's economic viability and associated risks, and evaluating the sponsor's track record and reputation. Explanation. Scenario analysis. This scenario presents a common challenge for principals in the securities industry, ensuring that the due diligence performed on a direct participation program, DPP, is not merely a perfunctory exercise but a robust, independent, and objective evaluation. The principal's responsibility extends beyond simply reviewing documents provided by the sponsor. It requires a critical assessment of the program's viability, risks, and alignment with investor suitability standards. The challenge lies in balancing the need for efficient review with the absolute requirement for thoroughness, especially when faced with time pressures or a desire to facilitate a sale. Failure to conduct adequate due diligence can expose investors to undue risk and lead to regulatory sanctions for the firm and the principal. Correct approach analysis. The best professional practice involves an independent and objective assessment of the DPP's offering documents, sponsor's track record, and the program's underlying economics and risks. This includes verifying information presented, scrutinizing assumptions, and evaluating the reasonableness of projected returns in light of the inherent risks. A key component is understanding the sponsor's experience and reputation in managing similar programs and assessing the alignment of the program's structure and fees with investor interests. This approach directly aligns with the principles of investor protection mandated by FINRA rules, which require members to have a reasonable basis for believing that a recommended investment is suitable for the customer. For DPP, this means understanding the program's specific risks, illiquidity, tax implications, and the sponsor's ability to execute the business plan. Incorrect approaches analysis. Relying solely on the sponsor's representations and marketing materials without independent verification is a significant regulatory and ethical failure. This approach abdicates the principal's responsibility to perform due diligence and places undue trust in potentially biased information. It violates the principle of investor protection by failing to identify or adequately assess risks that may not be transparently disclosed or are downplayed by the sponsor. Accepting the due diligence performed by another reputable firm without conducting an independent review is also professionally unacceptable. While leveraging the work of others can be efficient, the ultimate responsibility for due diligence rests with the principal and their firm. A superficial review of another firm's work, without understanding the methodology or independently verifying critical aspects, fails to meet the standard of care required. This can lead to the perpetuation of errors or omissions from the initial review, focusing primarily on the potential commission or profitability of the DPP, while not explicitly prohibited, can create an ethical conflict of interest that compromises the objectivity of the due diligence process. If the principal's primary motivation is financial gain, they may be inclined to overlook or minimize risks to facilitate the sale. This approach undermines the fiduciary duty owed to investors and is contrary to the spirit of regulatory oversight designed to ensure fair dealing. Professional reasoning. Professionals should approach due diligence for DPPs with a mindset of skepticism and a commitment to investor protection. The decision-making process should begin with a clear understanding of the regulatory requirements and the firm's internal policies. A systematic approach is crucial, involving 1. Thoroughly reviewing all offering documents, including the private placement memorandum, PPM, and subscription agreement. 2. Investigating the sponsor's background, experience, financial stability, and past performance in similar ventures. 3. critically evaluating the program's business plan, economic projections, and risk factors, seeking independent corroboration where possible. 4. Assessing the program's fee structure and its impact on investor returns. 5. Ensuring that the program's characteristics align with the suitability profiles of potential investors. Any red flags or areas of concern should be thoroughly investigated and addressed before any recommendation or sale is made. Question 2. The assessment process reveals that a registered representative in California, while reviewing documentation for a new direct participation program offering, identifies a discrepancy in the financial projections presented in the registration statement that appears to be a material omission. What is the most appropriate immediate course of action for the representative to take? Option A. Immediately report the suspected material omission to the firm's compliance department and legal counsel. Option B. Directly contact the issuer of the direct participation program to discuss and resolve the suspected omission. Option C. Attempt to correct the financial projection discrepancy independently before notifying anyone at the firm. Option D. Ignore the discrepancy, assuming it is a minor error that will be rectified by the issuer or other parties. The correct answer is A. Immediately report the suspected material omission to the firm's compliance department and legal counsel. Explanation. The assessment process reveals a scenario where a registered representative, Sarah, is faced with a situation involving a potential misstatement in a direct participation program's DPP registration statement. This is professionally challenging because it directly implicates Section 11 of the Securities Act of 1933, which imposes strict civil liabilities on those who sign, are directors of, or are involved in the preparation of registration statements containing untrue statements of material fact or omissions of material facts. The core challenge lies in identifying and responding to such potential misstatements without causing undue harm to investors or the firm, while adhering to legal and ethical obligations. Careful judgment is required to balance the duty to investors with the operational realities of the securities industry in the United States. The best professional approach involves immediately reporting the suspected misstatement to the firm's compliance department and legal counsel. This approach is correct because it aligns directly with regulatory requirements and best practices for handling potential violations of securities laws. Section 11 provides a private right of action for purchasers of securities against individuals and entities involved in the registration process if the registration statement contains a material misstatement or omission. By promptly escalating the issue internally, Sarah is initiating the firm's established procedures for investigating and rectifying such problems. This ensures that the matter is handled by those with the expertise and authority to assess the materiality of the misstatement, determine the appropriate corrective actions, which could include amending the registration statement, notifying investors, or even halting sales, and manage the firm's potential liability under Section 11. This proactive internal reporting is crucial for demonstrating due diligence and good faith, which can be mitigating factors in potential legal proceedings. An incorrect approach would be to ignore the suspected misstatement, assuming it is minor or will be corrected by others. This is professionally unacceptable because it directly violates the spirit and letter of Section 11. By failing to act, Sarah could be seen as complicit in the misstatement, potentially exposing herself and the firm to significant civil liability. Furthermore, it breaches the ethical duty to act in the best interests of investors and to uphold the integrity of the securities markets. Another incorrect approach would be to attempt to correct the misstatement independently without involving compliance or legal. This is professionally unacceptable because it bypasses the firm's established control mechanisms and regulatory oversight. Sarah may not have the full picture of the misstatement's impact, the legal ramifications, or the appropriate corrective procedures. Attempting to fix it herself could inadvertently worsen the situation or create new liabilities for herself and the firm, and it fails to engage the necessary expertise to properly address a potential Section 11 violation. A final incorrect approach would be to disclose the suspected misstatement directly to investors without first consulting with the firm's compliance and legal departments. This is professionally unacceptable as it could lead to premature or inaccurate disclosures, potentially causing unnecessary panic among investors, market disruption, and significant legal and reputational damage to the firm. Furthermore, it circumvents the structured process for managing and disclosing material information, which is critical for maintaining investor confidence and complying with securities regulations. The professional reasoning process in such situations should involve a clear understanding of one's reporting obligations, a commitment to internal escalation procedures, and a recognition of the severe consequences associated with misstatements in registration statements under Section 11. When faced with a potential issue, the first step should always be to consult internal policies and procedures, followed by immediate notification of the appropriate internal stakeholders, typically compliance and legal. This ensures a coordinated, informed, and legally sound response. Question 3. Regulatory review indicates that a principal of a broker-dealer firm in California is reviewing a new direct participation program, DPP, offering that has been registered with the SEC. The principal's objective is to determine if the firm should offer this DPP to its clients. Which of the following actions represents the most appropriate due diligence activity for the principal? Option A. Proving the DPP for sale to clients solely because it has successfully completed the SEC registration process. Option B. Discussing the potential tax advantages of the DPP with a prospective client, highlighting how these benefits could offset other income. Option C. Reviewing the DPP's offering memorandum and prospectus to understand its structure, investment objectives, risks, and fee arrangements, and ensuring all disclosures are adequate and compliant with California securities laws. Option D. Evaluating the DPP's historical performance data and comparing its projected returns to other available investment products in the market. The correct answer is C. Reviewing the DPP's offering memorandum and prospectus to understand its structure, investment objectives, risks, and fee arrangements, and ensuring all disclosures are adequate and compliant with California securities laws. Explanation. This scenario presents a professional challenge because it requires a principal to distinguish between legitimate due diligence activities and actions that could be construed as providing investment advice or making recommendations without proper registration or disclosure, particularly concerning a direct participation program, DPP. The principal's responsibility is to ensure that their firm and its associated persons operate within the bounds of FINRA regulations and state securities laws, specifically regarding the promotion and sale of DPPs. The best professional approach involves a thorough review of the DPP's offering documents and the associated risks, without making any subjective judgments or offering opinions on the investment suitability for any specific investor. This approach is correct because it aligns with the regulatory expectation that principals supervise the activities of their registered representatives and ensure that all sales literature and communications are fair, balanced, and do not misrepresent the investment. By focusing solely on the factual content of the offering documents and the inherent risks, the principal avoids engaging in activities that would require registration as an investment advisor or making recommendations that could lead to liability for the firm. This adheres to the principle of ensuring compliance with the Securities Act of 1933 and FINRA Rule 2210. Communications with the public. An incorrect approach involves evaluating the DPP's historical performance and comparing it to other investment opportunities. This is professionally unacceptable because it moves beyond due diligence into the realm of investment analysis and recommendation. Such an evaluation could be interpreted as providing investment advice, which requires specific licensing and adherence to suitability rules under FINRA Rule 2111. Suitability. Furthermore, focusing on historical performance without a comprehensive understanding of the DPP's structure and risks can be misleading and may not be indicative of future results, violating the principle of fair dealing and the prohibition against misleading statements. Another incorrect approach involves discussing the potential tax benefits of the DPP with a prospective investor without a clear disclaimer that the firm is not providing tax advice and that the investor should consult with a qualified tax professional. While understanding tax implications is part of due diligence, communicating these benefits directly to an investor without proper disclaimers or without being qualified to do so can lead to regulatory scrutiny. This could be seen as providing advice that falls outside the scope of securities sales and potentially into the territory of tax advice, which requires separate licensing and expertise. It also risks misrepresenting the nature and certainty of tax benefits, which are often subject to complex and changing tax laws. A final incorrect approach involves approving the sale of the DPP based solely on the fact that it has been registered with the Securities and Exchange Commission, SEC. While SEC registration is a prerequisite for public offering, it does not constitute an endorsement or approval of the investment's quality or suitability. Principals have an independent duty to conduct due diligence and ensure that the offering is suitable for the firm to offer, and that associated persons are equipped to sell it appropriately. Relying solely on SEC registration bypasses the critical supervisory responsibilities mandated by FINRA and state securities regulators, failing to protect investors from potentially unsuitable or risky investments. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves a clear understanding of the scope of their role as a principal, distinguishing between factual due diligence and investment advice. When reviewing DPPs, the focus should remain on the offering documents, the disclosure of risks, and the firm's policies and procedures for selling such products. Any communication with investors should be carefully vetted to ensure it is fair, balanced, and compliant with all applicable regulations, with appropriate disclaimers where necessary. If a situation requires providing investment advice or discussing specific investor suitability, the principal must ensure that the registered representative involved is properly licensed and adhering to all suitability requirements. Question 4. Consider a scenario in California where a firm is wholesaling a direct participation program, DPP. The firm pays its wholesalers a fee for their efforts in promoting the DPP to potential investors and facilitating sales. The firm's internal accounting department suggests classifying these wholesaler fees as marketing and distribution expenses, rather than underwriting expenses. What is the most appropriate regulatory and ethical approach for the firm to take regarding the classification of these wholesaler fees? Option A. Classify wholesaler fees as marketing and distribution expenses, separate from underwriting to reflect their promotional nature. Option B. Disclose wholesaler fees as a general operational cost of the firm, not directly tied to the specific DPP. Option C. Classify all wholesaler fees as underwriting expenses, ensuring full and transparent disclosure as required by FINRA regulations. Option D. Pay wholesaler fees through a separate entity to avoid direct classification as underwriting compensation. The correct answer is C. Classify all wholesaler fees as underwriting expenses, ensuring full and transparent disclosure as required by FINRA regulations. Explanation. This scenario presents a professional challenge because it involves a potential conflict of interest and a mischaracterization of compensation, which directly implicates the regulatory framework governing direct participation programs, DPP, and their associated underwriting and wholesaling activities in California. The core issue is whether compensation paid to a wholesaler for promoting a DPP is truly an underwriting expense, or if it represents something else that requires different disclosure or treatment. The FINRA rules, specifically those related to underwriting compensation and disclosure, are paramount here. A careful judgment is required to ensure compliance and uphold ethical standards. The correct approach involves accurately classifying all compensation paid to wholesalers as underwriting compensation. This is because the wholesaler's role in promoting and facilitating the sale of the DPP is intrinsically linked to the underwriting process. Their efforts directly contribute to the successful distribution of the program's securities, and the compensation they receive is a cost associated with that distribution. Under FINRA rules, all such costs are considered underwriting expenses and must be appropriately disclosed and accounted for. This approach ensures transparency with investors and adherence to the regulatory definition of underwriting compensation, preventing any misrepresentation or circumvention of disclosure requirements. An incorrect approach would be to classify wholesaler compensation as a general administrative expense or a marketing expense separate from underwriting. This mischaracterization is problematic because it attempts to distance the compensation from its direct link to the sale of the DPP securities. FINRA views compensation paid to individuals involved in the distribution of securities as underwriting compensation, regardless of how it is labeled internally. Failing to treat it as such violates disclosure rules and can mislead investors about the true costs associated with the program. Another incorrect approach would be to pay the wholesaler a commission that is not disclosed as part of the underwriting spread. This is a direct violation of FINRA rules that require full and fair disclosure of all underwriting compensation. Such undisclosed compensation can create an appearance of impropriety and may incentivize the wholesaler to prioritize their own undisclosed compensation over the best interests of the investors. A further incorrect approach would be to structure the compensation in a way that avoids the definition of underwriting compensation by, for example, paying it through a third-party marketing firm without clear documentation linking it to the DPP's distribution. This is an attempt to circumvent regulatory oversight and transparency requirements. FINRA regulations are designed to look through such arrangements to the substance of the transaction, and any compensation paid to facilitate the sale of securities will likely be scrutinized as underwriting compensation. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves a thorough understanding of FINRA rules regarding underwriting compensation and DPPs. When faced with questions about compensation structures, professionals should err on the side of caution and seek clarity from legal and compliance departments. The guiding principle should be transparency and accurate disclosure to investors, ensuring that all costs associated with the distribution of securities are properly identified and accounted for as underwriting expenses. Question 5. Upon reviewing the distribution strategy for a new direct participation program, DPP, in California, a sponsor is considering engaging several unaffiliated wholesaling firms to expand its sales reach. What is the most prudent and compliant approach for the sponsor to take when utilizing these outside wholesalers? Option A. Rely solely on the unaffiliated wholesalers to manage their own compliance and registration requirements for selling the DPP in California, without implementing any independent oversight from the sponsor. Option B. Provide only basic, generic product information to the unaffiliated wholesalers, focusing on the DPP's general features and assuming they will handle all specific suitability and disclosure requirements for California investors. Option C. Conduct thorough due diligence on each unaffiliated wholesaler, verifying their registration status with FINRA and the California DFPI, ensuring they are properly licensed to sell securities in California, and providing comprehensive, specific training on the DPP offering and its compliance requirements, followed by ongoing monitoring. Option D. Assume that the unaffiliated wholesalers' existing FINRA registrations are sufficient for selling any DPP in California, and proceed with engagement without further specific vetting or training. The correct answer is C. Conduct thorough due diligence on each unaffiliated wholesaler, verifying their registration status with FINRA and the California DFPI, ensuring they are properly licensed to sell securities in California, and providing comprehensive, specific training on the DPP offering and its compliance requirements, followed by ongoing monitoring. Explanation. Scenario analysis. This scenario presents a common challenge for dealer managers or sponsors of direct participation programs, DPP in California. The core issue revolves around the responsible and compliant use of outside or unaffiliated wholesalers. The challenge lies in ensuring that while leveraging external expertise and reach, the sponsor maintains adequate oversight and control to prevent misrepresentations, ensure suitability, and uphold regulatory standards, particularly concerning the registration and conduct of these wholesalers. The complexity arises from balancing the benefits of expanded distribution with the inherent risks of diminished direct control. Correct approach analysis. The best professional practice involves establishing a robust due diligence and oversight process for any unaffiliated wholesaler. This includes verifying their registration status with FINRA and the California Department of Financial Protection and Innovation, DFPI, confirming they are properly licensed to sell securities in California, and conducting thorough background checks. Furthermore, the sponsor must provide comprehensive training on the specific DPP offering, its risks, and compliance requirements. Ongoing monitoring of their sales activities, including review of sales literature and customer suitability, is crucial. This approach directly addresses the regulatory requirement under California Corporations Code Section 25210 and related rules, which mandate that broker-dealers and their associated persons must be registered and conduct business in accordance with applicable laws and ethical standards. By proactively ensuring compliance and understanding, the sponsor mitigates risk and fulfills its supervisory obligations. Incorrect approaches analysis. One incorrect approach involves assuming that an unaffiliated wholesaler's existing FINRA registration automatically satisfies all California-specific requirements and permits them to sell any DPP without further vetting. This fails to recognize that California has its own registration and licensing requirements for individuals and firms selling securities, and that specific product knowledge and training are essential for compliance. This approach risks violating California Corporations Code Section 25,210 by engaging unregistered persons or persons not properly licensed for the specific securities being offered. Another incorrect approach is to delegate all responsibility for wholesaler compliance to the unaffiliated wholesaler themselves, without implementing any independent verification or oversight by the sponsor. While the wholesaler has their own compliance obligations, the sponsor, as the issuer or distributor, retains ultimate responsibility for the offering and the conduct of those selling it. This abdication of responsibility can lead to significant regulatory violations and reputational damage, as the sponsor cannot claim ignorance of the wholesaler's actions. A third incorrect approach is to provide minimal, generic training to unaffiliated wholesalers, focusing only on the basic features of the DPP, without delving into the specific risks, suitability requirements, or California-specific disclosure obligations. This superficial training is insufficient to ensure that wholesalers can accurately and compliantly present the offering to potential investors in California. It increases the likelihood of misrepresentations or unsuitable sales, thereby violating the spirit and letter of investor protection laws. Professional reasoning. Professionals should approach the engagement of outside wholesalers with a risk-based mindset. The primary consideration must always be investor protection and regulatory compliance. This involves a multi-step process. First, understanding the specific regulatory landscape of California concerning security sales and DPPs. Second, conducting thorough due diligence on any potential wholesaler, verifying their credentials and regulatory standing. Third, implementing a comprehensive training program tailored to the specific offering and jurisdiction. Finally, establishing ongoing monitoring and supervision mechanisms to ensure continued compliance and identify any potential issues promptly. This systematic approach ensures that the benefits of expanded distribution are realized without compromising the integrity of the offering or the protection of California investors. Question 6. When evaluating the sales process for a direct participation program in Ontario, Canada, and a prospective investor has signed a subscription agreement, what is the most critical disclosure regarding the finalization of the sale? Option A. The investor should assume the subscription will be accepted unless otherwise notified. Option B. The subscription is contingent upon the acceptance of the subscriber by the issuer or general partner. Option C. The investor's signature on the subscription agreement constitutes a binding and final sale. Option D. The acceptance of the subscriber by the issuer or general partner is typically a mere formality. The correct answer is B. The subscription is contingent upon the acceptance of the subscriber by the issuer or general partner. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a situation where a sales representative might feel pressured to secure a sale, potentially overlooking crucial investor protections. The core issue is ensuring that the investor's decision to subscribe is fully informed and voluntary, rather than being coerced or unduly influenced by the sales process. The requirement for acceptance of subscribers by the issuer or general partner introduces a layer of control that must not be circumvented or misrepresented. Correct approach analysis. The best professional practice involves clearly and accurately communicating to the prospective investor that the subscription is subject to acceptance by the issuer or general partner. This approach ensures transparency and manages the investor's expectations appropriately. It aligns with the regulatory principle of fair dealing and the ethical obligation to provide complete and truthful information. By explicitly stating this condition, the representative upholds the integrity of the sales process and respects the investor's right to make a decision based on accurate information, knowing that the final commitment rests with the program sponsor. Incorrect approaches analysis. One incorrect approach is to imply or state that the sale is finalized upon the investor's signature, without mentioning the acceptance contingency. This is a direct misrepresentation of the subscription process and violates the duty to provide accurate information. It creates a false sense of certainty for the investor and can lead to disputes if the subscription is subsequently rejected. Another incorrect approach is to downplay the significance of the acceptance clause, suggesting it is a mere formality that will always be met. This is misleading because acceptance is a genuine condition, and the issuer or general partner has the right to reject subscriptions for various reasons, such as suitability concerns or insufficient capital. Failing to emphasize this condition undermines the investor's understanding of the complete transaction. A third incorrect approach is to proceed with the sale without any mention of the acceptance requirement, hoping the investor will not inquire or that the acceptance will be a swift and uneventful step. This omission is a failure to disclose a material term of the offering, which is a significant regulatory and ethical breach. Professional reasoning. Professionals should always prioritize transparency and accuracy in client communications. When evaluating sales processes for direct participation programs, it is imperative to understand and clearly articulate all material terms and conditions of the investment. This includes any contingencies or conditions precedent to the finalization of the sale, such as the issuer's or general partner's acceptance of the subscriber. A robust decision-making process involves asking, have I fully and accurately disclosed all relevant information to the investor, enabling them to make an informed decision? If the answer is anything less than a confident yes, the approach needs to be revised. Question 7. The analysis reveals that a new direct participation program sponsor based in Texas has approached your firm, a registered broker-dealer in California, seeking to have its latest oil and gas drilling program offered to your clients. The sponsor has provided a glossy marketing brochure and a brief executive summary of the program. As the principal responsible for approving new offerings, what is the most appropriate course of action to ensure compliance with FINRA regulations? Option A. Rely on the provided marketing brochure and executive summary, assuming that if the sponsor is actively seeking distribution, the program has already met all necessary regulatory hurdles. Option B. Proceed with offering the program to clients, but include a disclaimer in all client communications stating that the firm has not conducted independent due diligence on the program's specifics. Option C. Approve the program for sale after a brief discussion with the sponsor's sales team, who assure you that the program is highly sought after by other investment firms. Option D. Conduct a thorough review of the program's offering memorandum, partnership agreement, financial projections, and the sponsor's background, including their regulatory history and experience in managing similar programs. The correct answer is D. Conduct a thorough review of the program's offering memorandum, partnership agreement, financial projections, and the sponsor's background, including their regulatory history and experience in managing similar programs. Explanation. The analysis reveals a scenario that is professionally challenging due to the inherent conflict between a firm's desire to expand its product offerings and the paramount regulatory obligation to conduct thorough due diligence on any new investment program. The principal's responsibility extends beyond simply approving a product for sale. It necessitates a deep understanding of the program's structure, risks, and the sponsor's capabilities to ensure investor protection, a core tenet of FINRA regulations governing direct participation programs. Careful judgment is required to balance business opportunities with compliance mandates. The best professional approach involves a comprehensive review of the direct participation program's offering documents, financial projections, and the sponsor's track record, including any prior disciplinary actions or regulatory issues. This approach is correct because it directly addresses the due diligence requirements mandated by FINRA Rule 2111, suitability, and the NAST Rule 2810, direct participation programs. These rules obligate member firms and their principals to have a reasonable basis to believe that a recommended investment is suitable for a particular customer, which begins with a thorough understanding of the product itself and the entity offering it. This includes scrutinizing the program's economic viability, the experience and integrity of the sponsor, and the clarity of disclosures regarding risks and fees. An incorrect approach would be to rely solely on the marketing materials provided by the program sponsor. This is professionally unacceptable because marketing materials are inherently promotional and may not present a balanced or complete picture of the investment's risks and potential downsides. Regulatory bodies like FINRA expect principals to go beyond superficial information and conduct an independent assessment, Another incorrect approach would be to approve the program for sale based on the assumption that if other firms are offering it, it must be sound. This abdication of responsibility is a significant regulatory failure. FINRA rules require each member firm to conduct its own due diligence, irrespective of what competitors are doing. The firm's obligation is to its own clients and to upholding regulatory standards, not to mirror the practices of other market participants. Finally, an incorrect approach would be to approve the program based on a cursory review of the executive summary without delving into the detailed provisions of the offering documents. This superficial examination fails to uncover potential red flags related to fee structures, liquidity, or the sponsor's operational capacity, thereby violating the spirit and letter of due diligence requirements. The professional decision-making framework for such situation should involve a systematic process. First, identify the regulatory obligations related to the product type. Second, gather all relevant documentation, including offering documents, financial statements, and sponsor background information. Third, critically analyze this information for potential risks, conflicts of interest, and compliance with regulatory standards. Fourth, consult with legal and compliance departments if any ambiguities or concerns arise. And fifth, document the entire due diligence process and the basis for the decision. Question 8. The evaluation methodology shows that a sponsor of a direct participation program in California is conducting an all-or-none offering. The offering period is set to expire next week, and the sponsor has informed the registered representative that they are still short of the minimum subscription amount required for the offering to close. The sponsor is asking the representative if they can proceed with the closing by using funds from a separate, wholly owned subsidiary to cover the shortfall, representing to investors that the minimum has been met. Which of the following actions best adheres to the regulatory framework governing such offerings in the United States? Option A. Terminate the offering and return all investor funds promptly and without deduction, as the minimum subscription has not been met. Option B. Proceed with the closing using funds from the subsidiary, representing to investors that the minimum subscription has been met. Option C. Proceed with the closing and disclose the use of subsidiary funds to make up the shortfall in a post-closing amendment to the offering documents. Option D. Extend the offering period for an additional 30 days without informing existing investors, hoping to reach the minimum. The correct answer is A. Terminate the offering and return all investor funds promptly and without deduction, as the minimum subscription has not been met. Explanation. The evaluation methodology shows that this scenario is professionally challenging due to the inherent conflict between the sponsor's desire to raise capital quickly and the regulatory obligation to ensure investors receive accurate and non-misleading information, particularly concerning the success or failure of an offering. Rule 10b-9, under the Securities Exchange Act of 1934 in the United States, strictly prohibits deceptive practices in connection with the offering of securities, especially when the offering is contingent upon a minimum subscription level. Misrepresenting the status of subscriptions or the likelihood of closing an offering can lead investors to commit capital under false pretenses, violating their trust and the principles of fair dealing. The best professional approach involves a scrupulous adherence to the terms of the offering, including the minimum subscription requirement. This means that if the minimum amount of capital is not raised by the specified deadline, the offering must be terminated, and all funds returned to investors promptly and without deduction. This approach is correct because it directly aligns with the prohibitions of Rule 10b-9, which aims to prevent all-or-none or minimum-maximum offerings from being misrepresented. By ensuring that the offering is only completed if the minimum is met and that funds are returned if it is not, the sponsor upholds the integrity of the offering process and protects investors from being bound to an investment that will not proceed as intended. This demonstrates a commitment to transparency and compliance with federal securities laws. An incorrect approach would be to represent that the minimum subscription has been met when it has not, perhaps by using funds from a related entity or by extending the offering period without proper disclosure and investor consent. This is a direct violation of Rule 10b-9, as it misrepresents the success of the offering and deceives investors about the conditions under which their investment will proceed. Another incorrect approach is to proceed with the closing of the offering despite failing to meet the minimum subscription requirement, especially if the sponsor intends to use their own funds or those of an affiliate to make up the shortfall without full disclosure. This circumvents the all-or-none or minimum-maximum nature of the offering and can mislead investors into believing the offering was successful based on external investor participation. Furthermore, delaying the return of funds to investors beyond a reasonable period after the offering's termination, without a legitimate and disclosed reason, can also be considered a deceptive practice, as it ties up investor capital under false pretenses. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves thoroughly understanding the terms of the offering, particularly any minimum subscription requirements, and ensuring all communications and actions are consistent with those terms and Rule 10b-9. When faced with a situation where the minimum is not met, the professional must immediately consult the offering documents and relevant regulations to determine the appropriate course of action, which typically involves terminating the offering and returning funds. Open and honest communication with investors about the offering status is paramount, and any deviation from the stated terms must be handled with extreme caution and full disclosure. Question 9. Implementation of a new direct participation program offering in California requires a broker-dealer to engage with the issuer. Which of the following approaches best ensures compliance with regulatory requirements and ethical obligations to investors? Option A. The broker-dealer assumes that because the DPP is registered with the Securities and Exchange Commission, it is inherently suitable for a broad range of investors seeking growth opportunities. Option B. The broker-dealer relies primarily on the issuer's marketing materials and prospectus to understand the program's features and risks, assuming these documents fully represent the investment opportunity. Option C. The broker-dealer prioritizes the potential tax benefits highlighted by the issuer, focusing sales efforts on clients who are likely to benefit from these tax advantages, with less emphasis on the underlying investment's economic performance. Option D. The broker-dealer conducts independent due diligence on the DPP, thoroughly reviews all issuer disclosures, and ensures its sales force is adequately trained on the program's specific risks and suitability requirements before recommending it to clients. The correct answer is D. The broker-dealer conducts independent due diligence on the DPP, thoroughly reviews all issuer disclosures, and ensures its sales force is adequately trained on the program's specific risks and suitability requirements before recommending it to clients. Explanation. Scenario analysis. This scenario presents a common challenge in the securities industry, ensuring that broker-dealers and their sales forces adequately understand and disclose the risks associated with direct participation programs, DPP, to potential investors. The interface between the issuer and the broker-dealer is critical for the effective distribution of these complex products. A failure at this stage can lead to misrepresentation, unsuitable recommendations, and significant investor harm, potentially resulting in regulatory sanctions and reputational damage for all parties involved. The challenge lies in balancing the issuer's need to promote its product with the broker-dealer's fundamental obligation to conduct due diligence and ensure suitability for its clients. Correct approach analysis. The best professional practice involves the issuer providing comprehensive and transparent disclosure documents, including detailed risk factors, financial projections, with appropriate caveats, and information about the management team and their experience. The broker-dealer must then conduct its own independent due diligence on the DPP, verifying the information provided by the issuer, and assessing the program's suitability for its client base. Sales representatives must be thoroughly trained on the specific risks and characteristics of the DPP, and must ensure that any recommendations made to clients are suitable based on the client's financial situation, investment objectives, and risk tolerance. This approach prioritizes investor protection by ensuring that all parties have a clear understanding of the product's risks and that recommendations are aligned with investor needs. This aligns with FINRA Rule 2111, Suitability, and other regulations requiring broker-dealers to have reasonable grounds for believing that a recommendation is suitable for a particular customer. Incorrect approach is analysis. Relying solely on the issuer's marketing materials without independent verification by the broker-dealer is a significant regulatory and ethical failure. Marketing materials are often promotional and may not fully disclose all material risks. This approach violates the broker-dealer's duty of due diligence and can lead to unsuitable recommendations. Assuming that because a DPP is registered with the Securities and Exchange Commission, SEC, it is inherently safe and suitable for all investors is another critical error. SEC registration signifies compliance with disclosure requirements, but does not guarantee the investment's quality or suitability for any specific investor. This overlooks the inherent risks associated with DPPs, such as illiquidity, potential for loss of principal, and tax complexities. Focusing exclusively on the potential tax benefits presented by the issuer, without a thorough assessment of the underlying investment's economic viability and associated risks, is also professionally unacceptable. While tax advantages can be a component of an investment decision, they should not overshadow the fundamental investment merits and risks. This approach can lead to recommendations that are driven by tax considerations rather than sound investment principles, potentially exposing investors to undue risk. Professional reasoning. Professionals must adopt a risk-based approach to evaluating and recommending DPPs. This involves a multi-step process. 1. Understand the product. Thoroughly review all disclosure documents, including the prospectus, and understand the program's structure, objectives, and underlying assets. 2. Issuer due diligence. Evaluate the issuer's reputation, financial stability, and track record. 3. Broker-dealer due diligence. Conduct independent verification of key information and assess the program's overall viability and risk profile. 4. Sales force training. Ensure that all sales personnel are adequately trained on the product's risks, benefits, and suitability requirements. 5. Client suitability assessment. Rigorously assess each client's financial situation, investment objectives, risk tolerance, and experience before making any recommendation. 6. Transparent disclosure. Clearly and comprehensively communicate all material risks and potential downsides to the client, ensuring they understand the speculative nature of DPPs. Question 10. To address the challenge of ensuring fair and balanced communication regarding potential returns for a new real estate direct participation program, DPP, in California, a principal reviews a projection that estimates a 15% annualized net return to investors over a 5-year holding period, based on an assumed 95% occupancy rate and a 6% annual increase in rental income. What is the most appropriate method for the principal to ensure compliance with FINRA prohibited practices regarding misleading statements? Option A. Calculate the projected net return to the investor under the stated assumptions, and then present a sensitivity analysis showing how the net return changes if the occupancy rate drops to 85% or rental income increases by only 4% annually. Option B. Present the projected 15% annualized net return as a target return, emphasizing that this is the goal of the investment strategy. Option C. State that the 15% projected return is an estimate and that actual returns may vary significantly, without providing specific quantitative examples of this variation. Option D. Focus the presentation on the gross potential return of the property before any management fees, acquisition costs, or disposition fees are deducted. The correct answer is A. Calculate the projected net return to the investor under the stated assumptions, and then present a sensitivity analysis showing how the net return changes if the occupancy rate drops to 85% or rental income increases by only 4% annually. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to generate revenue and the regulatory imperative to prevent misleading or fraudulent practices in direct participation programs, DPP. The principal's responsibility is to ensure that all communications, particularly those involving financial projections, are not only accurate but also presented in a manner that avoids creating unrealistic expectations or obscuring material risks. The calculation of potential returns, especially when based on assumptions, requires a high degree of diligence and adherence to FINRA rules regarding fair dealing and suitability. Correct approach analysis. The best professional practice involves calculating the projected net return to the investor based on the provided assumptions, and then clearly disclosing the sensitivity of this return to changes in those assumptions. This approach directly addresses the prohibition against misleading statements by quantifying potential outcomes and highlighting the inherent uncertainties. By presenting a range of potential returns or a clear statement of how the projected return changes with variations in key assumptions, e.g., occupancy rates, operating expenses, exit capitalization rates, the principal ensures that the communication is fair, balanced, and not likely to mislead investors about the potential risks and rewards. This aligns with FINRA Rule 2110, standards of commercial honor and principles of fair dealing, and the general anti-fraud provisions that prohibit misrepresentations or omissions of material facts. Incorrect approach is analysis. One incorrect approach involves presenting only the most optimistic projected net return without disclosing the assumptions or the potential for lower returns if those assumptions are not met. This is a direct violation of the prohibition against misleading statements and omissions of material facts. It creates an unrealistic expectation for the investor and fails to provide a balanced view of the investment's potential outcomes, thereby violating FINRA Rule 2110. Another incorrect approach is to simply state that the projections are estimates without providing any quantitative basis or context for those estimates. While acknowledging they are estimates is a step, it is insufficient to prevent misleading practices if the estimates themselves are not reasonably derived or if the potential variability is not communicated. This approach lacks the necessary transparency and detail to inform an investor adequately about the risks involved, potentially leading to a misrepresentation of the investment's prospects. A further incorrect approach is to focus solely on the gross potential return without accounting for all fees, expenses, and dilution. DPPs are often complex, with multiple layers of fees and expenses that can significantly impact the net return to the investor. Presenting a gross return without a clear calculation of the net return, or without a detailed breakdown of how fees and expenses affect the final outcome, can be considered misleading. This failure to account for all costs that reduce investor profit is a violation of fair dealing principles. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes transparency and investor protection. This involves 1. Thoroughly understanding the specific product being offered, including all fees, expenses, and underlying assumptions. 2. Quantifying potential outcomes, including best case, worst case, and most likely scenarios, and clearly articulating the assumptions driving these projections. 3. Ensuring all communications are fair, balanced, and not misleading, with a particular focus on disclosing material risks and uncertainties. 4. Adhering strictly to all applicable FINRA rules and securities regulations. When in doubt, err on the side of providing more information and clearer disclosures to the investor. Question 11. Examination of the data shows that a wholesaler distributing a direct participation program in California has received a base commission on sales, plus reimbursement for all travel and entertainment expenses incurred while meeting with potential investors and attending industry conferences. Under California securities regulations and FINRA rules applicable to the distribution of direct participation programs, how should these wholesaling compensation and expenses be classified? Option A. Only the base commission is considered compensation. Reimbursed expenses are treated as separate operational costs. Option B. Reimbursed expenses are considered compensation, but only if they exceed a certain percentage of the base commission. Option C. The base commission is compensation, and reimbursed expenses are considered marketing costs borne by the issuer, distinct from wholesaler compensation. Option D. Both the base commission and the reimbursed expenses are considered items of compensation to the wholesaler. The correct answer is D. Both the base commission and the reimbursed expenses are considered items of compensation to the wholesaler. Explanation. This scenario presents a professional challenge because it requires a clear understanding of how wholesaling compensation and expenses are treated under the regulatory framework governing direct participation programs in California. Misinterpreting these items can lead to violations of disclosure requirements, potentially misleading investors, and resulting in regulatory sanctions. Careful judgment is needed to ensure all compensation and expenses are accurately identified and disclosed according to FINRA rules and California state regulations. The correct approach involves recognizing that both wholesaling compensation and associated expenses are considered forms of compensation to the wholesaler. This aligns with the principle that any payment or reimbursement that directly or indirectly benefits a party involved in the distribution of a direct participation program should be considered compensation. This comprehensive view ensures that the total cost of distribution is transparent to investors and regulators, preventing any hidden fees or undisclosed benefits that could influence sales practices. FINRA Rule 2310 and related guidance, as well as California Corporations Code Section 25113 and related regulations, emphasize full and fair disclosure of all compensation arrangements. An incorrect approach would be to consider only the direct commission paid to the wholesaler as compensation, excluding any reimbursements for travel, entertainment, or other operational expenses incurred during wholesaling activities. This is flawed because these expenses are directly tied to the distribution effort and effectively reduce the wholesaler's out-of-pocket costs, thereby increasing their net benefit from the sale. Failing to include these reimbursements as part of the overall compensation package misrepresents the true cost of distribution and can violate disclosure obligations. Another incorrect approach would be to categorize wholesaling expenses as general operating costs of the issuer, separate from compensation. This is problematic as it severs the direct link between the expense and the promotional activity of the wholesaler. Expenses incurred by a wholesaler in promoting a DPP are not general issuer costs. They are costs incurred to facilitate the sale of the program, and thus are intrinsically linked to the compensation structure. This misclassification can lead to inaccurate financial reporting and a lack of transparency regarding the incentives driving sales. Finally, an incorrect approach would be to argue that only expenses directly related to the sale of a specific unit are compensation, while broader marketing or travel expenses are not. This is incorrect because the regulatory intent is to capture all financial benefits received by those involved in wholesaling. Expenses that enable or facilitate the wholesaler's ability to engage in wholesaling activities, even if not tied to a single unit sale, are part of the overall economic benefit they receive for their services. Professional reasoning process for such situations should involve a thorough review of applicable FINRA rules and California state securities laws concerning disclosure of compensation and expenses in direct participation programs. Professionals must adopt a broad interpretation of compensation to encompass all forms of remuneration, direct or indirect, including expense reimbursements, that benefit those involved in the distribution of securities. When in doubt, seeking guidance from legal counsel or compliance departments specializing in securities regulation is advisable to ensure full adherence to regulatory requirements. Question 12. Research into a client's expressed desire to offset significant year-end tax liabilities in Ontario, Canada, has led you to consider recommending a direct participation program, DPP. The client, who has a moderate risk tolerance and a need for liquidity within the next 3 to 5 years, is eager to invest quickly. You have identified a DPP that offers substantial tax deductions in the initial years. What is the most appropriate course of action? Option A. Fully disclose the illiquid nature of the DPP, the potential for loss of principal, the long-term commitment required, and the speculative nature of the tax benefits, ensuring the client understands these factors before proceeding with any recommendation. Option B. Emphasize the significant tax deductions available through the DPP and proceed with the investment to help the client meet their year-end tax obligations. Option C. Suggest that the DPP is a guaranteed method to offset tax liabilities, as this is the client's primary objective. Option D. Recommend the DPP, but advise the client that they may need to hold it for longer than their desired liquidity timeframe due to its illiquid nature. The correct answer is A. Fully disclose the illiquid nature of the DPP, the potential for loss of principal, the long-term commitment required, and the speculative nature of the tax benefits, ensuring the client understands these factors before proceeding with any recommendation. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial needs with the long-term suitability and regulatory compliance of an investment. The principal must exercise careful judgment to avoid misrepresenting the nature of the investment or pressuring the client into a decision that may not be in their best interest, especially given the illiquid and speculative nature of DPPs. The correct approach involves thoroughly explaining the risks and characteristics of the Direct Participation Program, DPP, to the client, emphasizing its illiquid nature, the potential for loss of principal, and the long-term commitment required. This approach is correct because it aligns with the fundamental principles of suitability and client best interest, as mandated by FINRA rules governing the sale of securities, particularly complex products like DPPs. Specifically, FINRA Rule 2111, Suitability, requires that a member firm or associated person have a reasonable basis to believe that a recommended transaction or investment strategy involving a security or an investment strategy involving a security is suitable for the customer, based on the customer's investment profile. This includes understanding the customer's financial situation, investment objectives, risk tolerance, and any other information obtained through reasonable diligence. Furthermore, the ethical obligation to act in the client's best interest, a cornerstone of professional conduct for registered representatives, dictates full disclosure and avoidance of undue pressure. An incorrect approach would be to downplay the risks and focus solely on the potential tax benefits or the client's stated desire for tax deductions. This fails to meet the suitability requirements by omitting crucial information about the investment's inherent risks and illiquidity, potentially leading the client to make an uninformed decision. It also violates the ethical duty to provide a balanced and complete picture of the investment. Another incorrect approach would be to proceed with the investment solely based on the client's expressed urgency to utilize tax deductions before year-end, without adequately assessing if the DPP is truly suitable for their overall financial situation and risk tolerance. This prioritizes a short-term client request over a comprehensive suitability assessment, potentially exposing the client to undue risk and violating regulatory obligations. A further incorrect approach would be to suggest that the DPP is a guaranteed way to offset tax liabilities, thereby misrepresenting the investment's potential outcomes. This constitutes a misleading statement and a failure to disclose the speculative nature and potential for loss associated with DPPs, directly contravening FINRA rules against misrepresentation and omission of material facts. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's profile. Gather comprehensive information about the client's financial situation, investment objectives, risk tolerance, time horizon, and liquidity needs. 2. Understand the product. Possess a thorough understanding of the specific DPP, including its structure, risks, potential returns, fees, liquidity, and tax implications. 3. Assess suitability. Determine if the DPP aligns with the client's profile. This is not just about meeting a stated need like tax deductions, but ensuring the investment is appropriate for the client's overall financial well-being. 4. Full and fair disclosure. Clearly and comprehensively explain all aspects of the DPP to the client, including risks, benefits, costs, and illiquidity, using language they can understand. 5. Document the process. Maintain detailed records of all client interactions, suitability assessments, and disclosures. 6. Prioritize client best interest. Always place the client's best interest above the firm's or the representative's interests. If a product is not suitable, it should not be recommended, regardless of potential commissions or client pressure. Question 13. Which approach would be most consistent with SEC regulation best interest when a client expresses a strong desire for aggressive growth and asks about a specific direct participation program, DPP, known for its high potential returns but also significant risks, and the registered representative works for a firm in California? Option A. Conduct a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon, and then determine if the specific DPP, with its associated risks and potential rewards, is suitable and in the client's best interest, considering other reasonably available alternatives. Option B. Focus the discussion solely on the potential high returns of the DPP, highlighting its aggressive growth characteristics to align with the client's stated desire, and proceed with the recommendation if the client remains enthusiastic. Option C. Advise the client that DPPs are generally too risky for most investors and suggest a more conservative investment strategy, even if it means not fulfilling the client's expressed desire for aggressive growth. Option D. Recommend the DPP immediately because the client expressed interest and the representative is familiar with the product, assuming the client understands the risks associated with aggressive investments. The correct answer is A. Conduct a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon, and then determine if the specific DPP, with its associated risks and potential rewards, is suitable and in the client's best interest, considering other reasonably available alternatives. Explanation. This scenario is professionally challenging because it requires a registered representative to balance the client's stated desire for aggressive growth with the fundamental obligation to recommend investments that are in the client's best interest, as mandated by SEC Regulation Best Interest, Reg BI, in the United States. The conflict arises when a product, while potentially offering high returns, carries significant risks that may not be fully understood or appropriate for for the client's financial situation and risk tolerance. Careful judgment is required to ensure that the recommendation is not driven by potential commissions or product availability, but by a genuine assessment of the client's needs. The best approach involves a thorough and documented assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon. This includes understanding the specific risks and potential rewards of the Direct Participation Program, DPP, being considered, and then determining if it aligns with the client's profile. If the DPP is deemed suitable, the representative must be able to articulate clearly to the client why it is in their best interest, considering all available alternatives. This approach prioritizes the client's welfare above all else, fulfilling the core tenets of Reg BI by acting in the client's best interest and exercising reasonable diligence, care, and skill. An incorrect approach would be to proceed with recommending the DPP solely based on the client's expressed interest in high returns, without conducting a comprehensive suitability analysis. This fails to meet the best interest obligation, because it neglects to consider whether the DPP's inherent risks are compatible with the client's overall financial picture and risk tolerance. It also likely fails to explore reasonably available alternatives that might offer similar growth potential with less risk, or to adequately disclose the material risks associated with the DPP. Another incorrect approach would be to recommend the DPP because it is a product the firm has available and that the representative is familiar with, without independently verifying its suitability for this specific client. This approach prioritizes the firm's product offerings or the representative's convenience over the client's unique circumstances, violating the duty to act in the client's best interest and to conduct a reasonable investigation into the investment. A further incorrect approach would be to present the DPP as a guaranteed path to high returns, downplaying or omitting its substantial risks. This constitutes a failure to provide full and fair disclosure of all material facts and risks, which is a cornerstone of Reg BI and a fundamental ethical obligation. It misleads the client about the potential outcomes and fails to equip them with the necessary information to make an informed decision. Professionals should employ a structured decision-making process that begins with a deep understanding of the client's profile. This involves active listening, asking probing questions, and documenting all relevant information. Next, the representative must conduct a thorough due diligence on any recommended investment, understanding its features, risks, and potential rewards. This analysis should be compared against the client's profile and other reasonably available investment options. Finally, the representative must be able to clearly and transparently communicate their recommendation, including the rationale and any associated risks, to the client, ensuring they have the information needed to make an informed decision. Question 14. Cost-benefit analysis shows that entering into a dealer/manager agreement with a direct participation program sponsor can be lucrative. But for a principal in California, what is the most prudent and regulatory compliant approach when presented with such an agreement? Option A. Sign the agreement promptly to capitalize on the potential revenue, without undertaking an in-depth investigation into the sponsor's background or the specific risks inherent in the direct participation program. Option B. Rely on the program sponsor's representations and assurances regarding the legality and fairness of the agreement, assuming they have acted in good faith. Option C. Conduct a thorough review of the proposed dealer/manager agreement with legal counsel to ensure full compliance with FINRA rules and California securities laws, scrutinizing disclosures, compensation, due diligence, and suitability provisions. Option D. Perform a superficial review of the agreement, focusing primarily on the compensation structure for the dealer-manager and selling group, while giving less attention to other disclosure and suitability clauses. The correct answer is C. Conduct a thorough review of the proposed dealer/manager agreement with legal counsel to ensure full compliance with FINRA rules and California securities laws, scrutinizing disclosures, compensation, due diligence, and suitability provisions. Explanation. Scenario analysis. This scenario presents a common challenge for principals in the securities industry when entering into dealer/manager agreements with program sponsors. The principal must ensure that the agreement aligns with regulatory requirements, protects the investing public, and establishes clear responsibilities and compensation structures. Failure to properly vet and structure this agreement can lead to regulatory violations, financial penalties, and reputational damage. The challenge lies in balancing the business objectives of the program with the stringent compliance obligations mandated by the Financial Industry Regulatory Authority, FINRA, and state securities regulators. Correct approach analysis. The best professional practice involves a thorough review of the proposed dealer/manager agreement by the principal and their legal counsel to ensure full compliance with all applicable FINRA rules and state securities laws in California. This includes scrutinizing the sponsor's disclosures, the proposed compensation structure for the dealer-manager and selling group, the due diligence performed by the sponsor, and the provisions for investor suitability and ongoing reporting. The agreement should clearly define the roles, responsibilities, and liabilities of all parties, and ensure that the program is structured to be fair and equitable to investors. This proactive and comprehensive approach minimizes regulatory risk and upholds ethical standards. Incorrect approaches analysis. Relying solely on the sponsor's assurances without independent legal and compliance review is a significant regulatory failure. This approach bypasses the principal's fundamental obligation to conduct due diligence and ensure compliance with California securities laws and FINRA regulations. It exposes the firm to potential violations related to inadequate disclosure, unsuitable sales practices, and improper fee arrangements. Accepting the agreement with only a cursory review of the compensation terms, while ignoring other critical disclosure and suitability provisions, is also professionally unacceptable. This selective review demonstrates a lack of commitment to comprehensive compliance and investor protection. It fails to address potential conflicts of interest or ensure that the program's structure meets regulatory standards beyond just the financial incentives. Signing the agreement without understanding the sponsor's track record or the specific risks associated with the direct participation program is a critical ethical and regulatory lapse. FINRA Rule 2310 and state regulations require principals to have a reasonable basis for believing in the suitability of the investment for investors. A lack of understanding of the program's underlying assets, operational structure, and sponsor's history directly undermines this requirement and can lead to the sale of unsuitable investments. Professional reasoning. Professionals should approach the execution of dealer/manager agreements with a rigorous, multifaceted due diligence process. This process should begin with a comprehensive review of the program sponsor and the proposed program itself, followed by a detailed examination of the dealer/manager agreement. Engaging qualified legal counsel specializing in securities law is paramount. The firm's compliance department must be actively involved in assessing the agreement against FINRA rules and relevant state securities laws, particularly regarding disclosure, suitability, and compensation. A risk-based approach should guide the depth of review, with greater scrutiny applied to programs involving novel structures, complex assets, or sponsors with less established track records. Ultimately, the decision to enter into such an agreement must be grounded in a commitment to investor protection and regulatory adherence. Question 15. Cost-benefit analysis shows that engaging an affiliate of the sponsor to assist in the sale of a direct participation program in California may offer efficiencies, but what is the most critical regulatory consideration for the sponsor to ensure compliance? Option A. The sponsor can proceed with the affiliate's involvement without explicit disclosure of the affiliate's relationship to the sponsor, as this is an internal matter. Option B. The sponsor must meticulously document the affiliate's role, ensure its activities align with FINRA rules and California securities laws, and guarantee full disclosure of the affiliate's relationship to potential investors. Option C. The sponsor can assume the affiliate's existing knowledge of the sponsor's business is sufficient for sales activities, requiring minimal additional training. Option D. The sponsor only needs to ensure the affiliate is aware of the DPP's investment objectives, without needing to verify specific registration or disclosure protocols. The correct answer is B. The sponsor must meticulously document the affiliate's role, ensure its activities align with FINRA rules and California securities laws, and guarantee full disclosure of the affiliate's relationship to potential investors. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves navigating the complex relationship between a sponsor of a direct participation program, DPP, and an affiliate of that sponsor. The core difficulty lies in ensuring that any involvement by the affiliate in the sale or promotion of the DPP adheres strictly to regulatory requirements, particularly concerning disclosure and potential conflicts of interest, without creating an appearance of impropriety or misleading investors. The Series 39 exam emphasizes the principal's responsibility to supervise and ensure compliance, making the affiliate's role a critical area for scrutiny. Correct approach analysis. The best professional practice involves the sponsor meticulously documenting the affiliate's role, clearly defining its responsibilities, and ensuring that all communications and sales activities undertaken by the affiliate fully comply with FINRA rules and state securities laws in California. This includes verifying that the affiliate is properly registered if required, has received adequate training on the specific DPP and relevant regulations, and that all disclosures regarding the affiliate's relationship to the sponsor are made transparently to potential investors. This approach prioritizes regulatory compliance and investor protection by proactively managing the risks associated with an affiliate's involvement. Incorrect approaches analysis. One incorrect approach is to assume that because the affiliate is closely associated with the sponsor, it can operate with less oversight or fewer disclosure requirements. This fails to recognize that regulatory obligations apply regardless of the degree of affiliation. Another unacceptable approach is to allow the affiliate to engage in sales activities without verifying its registration status or providing it with comprehensive training on the DPP and applicable regulations. This creates significant compliance risks and potential liability for both the affiliate and the sponsor. Furthermore, failing to clearly disclose the affiliate's relationship to the sponsor and its role in the offering to potential investors is a direct violation of disclosure requirements and can be considered misleading. Professional reasoning. Professionals must adopt a proactive and diligent approach when an affiliate of a sponsor is involved in DPP offerings. The decision-making framework should prioritize understanding the specific regulatory requirements applicable to the affiliate's activities, conducting thorough due diligence on the affiliate's qualifications and registration, and ensuring complete transparency with investors. Any doubt about compliance should lead to seeking clarification from legal or compliance departments before proceeding. The overarching principle is to always act in the best interest of the investor and to maintain the integrity of the offering process. Question 16. Risk assessment procedures indicate that a new investor in a direct participation program in California is ready to contribute a significant cash amount. As the principal overseeing this transaction, what is the most critical step to ensure regulatory compliance regarding the use of this cash? Option A. Accept the investor's cash contribution based on the signed subscription agreement, assuming the investor has reviewed and understood all associated financial commitments. Option B. Confirm that the offering documents clearly detail how the investor's cash contribution will be allocated to organizational expenses, offering costs, and program operations, and that the investor has acknowledged understanding this disclosure. Option C. Proceed with the investment upon receiving the cash, with the understanding that the investor is aware that their funds will be used for the program's general operational needs. Option D. Focus on the timely deposit of the cash into the program's account and defer detailed review of its specific allocation until after the offering closes. The correct answer is B. Confirm that the offering documents clearly detail how the investor's cash contribution will be allocated to organizational expenses, offering costs, and program operations, and that the investor has acknowledged understanding this disclosure. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to balance the immediate need for capital with the regulatory obligation to ensure that the cash invested in a direct participation program, DPP, is suitable and properly disclosed. The pressure to close a deal quickly can lead to overlooking critical disclosure requirements, potentially exposing both the investor and the firm to significant risks and regulatory scrutiny under FINRA rules governing DPPs. Correct approach analysis. The best professional practice involves ensuring that all cash contributions are clearly documented and that the investor fully understands how their cash will be utilized within the DPP structure, including any fees, commissions, or expenses. This aligns with the regulatory requirement under FINRA Rule 2310 and related interpretations to ensure that investments are suitable for the investor and that all material facts, including the use of proceeds and associated costs, are fully disclosed. A principal must verify that the offering documents clearly delineate the use of cash and that the investor has received and understood this information. This proactive verification prevents misrepresentation and ensures compliance with disclosure obligations. Incorrect approach is analysis. One incorrect approach is to accept the investor's cash contribution without a clear, documented understanding of its specific allocation within the DPP's operational and organizational expenses. This fails to meet the regulatory standard for disclosure and suitability, as the investor may not comprehend the full extent of costs deducted from their investment before it is deployed for the program's intended purpose. Another incorrect approach is to assume that because the investor provided the cash, they implicitly understand its use, and therefore no further detailed disclosure is necessary. This bypasses the principal's responsibility to ensure the investor is fully informed of all material facts, including the breakdown of how their cash will be applied to organizational costs, offering expenses, and program operations. Such an assumption can lead to allegations of misrepresentation or omission. A further incorrect approach is to focus solely on the receipt of funds and the completion of the subscription agreement, without independently verifying that the offering documents adequately detail the use of cash for organizational and offering expenses. While the subscription agreement is important, it does not absolve the principal of the duty to ensure the underlying disclosures regarding the use of investor funds are accurate and complete. Professional reasoning. Professionals should adopt a systematic approach to reviewing DPP investments. This involves 1. Thoroughly reviewing the offering documents to understand the proposed use of investor cash, including all associated fees and expenses. 2. Verifying that this information is clearly and accurately presented to the investor. 3. Ensuring the investor understands this information and that the investment is suitable for their financial situation and objectives. 4. Documenting all steps taken to ensure compliance and suitability. This structured process mitigates risk and upholds regulatory standards. Question 17. Compliance review shows that a broker-dealer firm in California is considering a new direct participation program offering and is exploring arrangements to incentivize selected dealers and their registered representatives to actively solicit investments in this program. Which of the following approaches best aligns with regulatory requirements and ethical conduct? Option A. Provide selected dealers with a significant upfront cash bonus for each DPP unit they commit to selling, without specific disclosure of this bonus to the end investors. Option B. Offer dealers exclusive access to non-cash compensation, such as luxury travel incentives, tied directly to the volume of DPP units sold by their representatives. Option C. Disclose all payments made to selected dealers and their representatives for their efforts in retaining and soliciting investors for the DPP, ensuring these payments are reasonable for services rendered and clearly documented. Option D. Structure payments as a general retainer fee to selected dealers for their participation in the offering, without detailing the specific services provided or disclosing the fee to investors. The correct answer is C. Disclose all payments made to selected dealers and their representatives for their efforts in retaining and soliciting investors for the DPP, ensuring these payments are reasonable for services rendered and clearly documented. Explanation. Scenario analysis. This scenario presents a common challenge in the securities industry, particularly concerning the distribution of direct participation programs, DPP. Firms and individuals are often incentivized to promote specific products. The challenge lies in ensuring that any compensation paid to dealers or solicitors for retaining or promoting these DPPs is structured and disclosed in a manner that is compliant with FINRA rules and does not create undue conflicts of interest or mislead investors. The core issue is distinguishing between legitimate, disclosed compensation for services rendered and arrangements that could be construed as an improper inducement to sell a particular product, potentially at the expense of the investor's best interest. Correct approach analysis. The best professional practice involves ensuring that any payments made to selected dealers or solicitors for retaining or promoting DPPs are fully disclosed to investors and are structured in a way that aligns with regulatory requirements. This means that the compensation must be reasonable for the services provided and clearly documented. Crucially, the disclosure must inform investors about the nature of the arrangement, including any potential conflicts of interest that might arise from such payments. This transparency is paramount under FINRA Rule 2121, Fair Prices and Commissions, and the general principles of fair dealing and investor protection. Such an approach ensures that investors are aware of all material facts that could influence their investment decisions. Incorrect approaches analysis. One incorrect approach involves making payments to selected dealers or solicitors without clear documentation or disclosure to investors. This failure to disclose material information violates FINRA Rule 2121 and the general duty of fair dealing. It creates a significant conflict of interest, as investors may not be aware that the dealer's recommendation or promotion is influenced by undisclosed compensation. Another incorrect approach is to structure payments as a flat fee for retaining a dealer, without a clear nexus to specific services performed in relation to the DPP offering. This can be viewed as an improper inducement, potentially violating FINRA Rule 2121 and the spirit of fair competition, as it may unfairly advantage certain dealers over others based on the payment structure rather than the quality of their services or the suitability of the product for investors. A further incorrect approach is to provide non-cash compensation, such as lavish gifts or entertainment, to dealers or solicitors in exchange for promoting DPPs. While FINRA permits certain non-cash compensation arrangements, these are strictly regulated and must be for business entertainment or education, and not directly tied to sales volume or the sale of specific products. Such arrangements, if not compliant with FINRA Rule 2121 and related guidance, can be seen as an improper incentive that compromises professional judgment and investor interests. Professional reasoning. Professionals must adopt a proactive and transparent approach to compensation arrangements. This involves thoroughly understanding FINRA rules regarding fair dealing, commissions, and non-cash compensation. Before entering into any agreement to pay dealers or solicitors for retaining or promoting DPPs, a firm should 1. Clearly define the services to be rendered and ensure the compensation is reasonable for those services. 2. Ensure all compensation is fully disclosed to investors in offering documents and other communications. 3. Maintain meticulous records of all payments and services. And 4. Regularly review these arrangements to ensure ongoing compliance and to mitigate any potential conflicts of interest. The guiding principle should always be the investor's best interest, supported by full transparency and adherence to regulatory mandates. Question 18. The audit findings indicate that a broker-dealer firm operating in California is receiving direct payments from a direct participation program, DPP, sponsor for the sale of that program's securities. Which of the following actions best demonstrates adherence to regulatory requirements and ethical conduct concerning this compensation arrangement? Option A. Accepting the direct payments from the program sponsor and including them within a general commission figure without specifically itemizing or explaining the source of the payment to the client. Option B. Fully disclosing the direct payment arrangement from the program sponsor to the client in writing, detailing its nature and potential implications, and ensuring the recommendation aligns with the client's suitability profile. Option C. Relying on the fact that direct payments from program sponsors are a common industry practice and therefore do not require specific client disclosure. Option D. Not disclosing the direct payment arrangement to the client, assuming that the sponsor's due diligence on the program is sufficient assurance for the investor. The correct answer is B. Fully disclosing the direct payment arrangement from the program sponsor to the client in writing, detailing its nature and potential implications, and ensuring the recommendation aligns with the client's suitability profile. Explanation. The audit findings indicate a potential conflict of interest and a lack of transparency in how dealers are compensated for selling direct participation programs, DPP, in California. This scenario is professionally challenging because it requires a careful balancing act between ensuring fair compensation for sales efforts and upholding the fiduciary duty owed to investors. The core issue revolves around the direct payment of dealer fees by the program sponsor, which can create incentives that may not align with the best interests of the investor. Regulatory bodies like FINRA, which governs broker-dealers in California, and the Securities and Exchange Commission, SEC, are vigilant about arrangements that could lead to conflicts of interest. The best professional practice in this situation is to ensure that all compensation arrangements are fully disclosed to investors and that the compensation structure itself does not create an undue incentive for the dealer to recommend a program solely based on the payout, rather than its suitability for the client. This involves a thorough review of the dealer agreement to understand the nature and extent of the direct payments from the sponsor. Crucially, this information must be clearly and conspicuously communicated to the client in writing, typically through the offering documents and potentially in a separate disclosure statement, before the client invests. This approach aligns with FINRA Rule 2060, fraudulent and manipulative misuse of non-public information, and the general principles of fair dealing and suitability, emphasizing transparency and investor protection. An approach that involves accepting direct payments from the program sponsor without fully disclosing the nature and potential impact of this compensation to the investor is ethically and regulatorily unsound. This failure to disclose creates a significant conflict of interest, as the dealer's financial gain is directly tied to the sale of the program, potentially overshadowing the client's investment objectives and risk tolerance. Such a practice violates the duty of loyalty and good faith owed to the client, and could be construed as a misrepresentation or omission under securities laws. Another unacceptable approach is to assume that because the payment structure is common in the industry, it requires no specific client disclosure. While direct payments from sponsors may be a standard industry practice, this does not absolve the dealer of their obligation to inform clients about how they are compensated. The fact that it is common does not make it inherently transparent or free from potential conflicts. Investors have a right to know how their financial advisor or broker is being compensated for recommending specific investments. Finally, an approach that attempts to obscure the direct payment by bundling it into a general commission structure without specific itemization or explanation also falls short. Transparency requires clarity. Simply stating a commission without detailing its source or the specific incentives it might create for the dealer is insufficient. The client should understand that a portion of their investment is directly compensating the dealer through a payment from the program sponsor, and the potential implications of this arrangement. Professionals should adopt a decision-making framework that prioritizes investor interests and regulatory compliance. This involves proactively identifying potential conflicts of interest inherent in compensation structures, such as direct payments from program sponsors. The next step is to thoroughly understand the specifics of these arrangements and their potential impact on investment recommendations. Most importantly, a commitment to full and clear disclosure to the client, in writing and in plain language, is paramount. This proactive transparency builds trust and ensures that clients can make informed investment decisions, free from the undue influence of potential conflicts of interest. Question 19. Stakeholder feedback indicates a concern regarding the diligence performed by underwriting firms in the state of California when entering into firm commitment agreements for direct participation programs. A California-based broker-dealer has entered into a firm commitment underwriting agreement for a new DPP. Following the agreement, the firm's internal review team identifies some potential concerns regarding the sponsor's historical performance in similar programs, and a slight increase in projected operating expenses for this specific DPP due to unforeseen market conditions. Which of the following approaches best demonstrates adherence to regulatory requirements and professional responsibility in California? Option A. Proceed with the offering as planned, relying on the firm commitment agreement as confirmation of the DPP's viability and the issuer's assurances that the identified concerns are minor and will not impact investor returns. Option B. Proceed with the offering but omit detailed discussion of the sponsor's historical performance and the revised expense projections from the offering documents, assuming investors will focus on the potential upside. Option C. Immediately withdraw from the firm commitment agreement due to the identified concerns, citing market volatility as the primary reason, without further investigation into the specific impact on the DPP. Option D. Conduct a thorough independent review of the sponsor's historical performance and the revised expense projections, and if material risks are identified, ensure these are fully and clearly disclosed in the offering documents, potentially adjusting the offering terms or recommending the issuer revise the program structure. The correct answer is D. Conduct a thorough independent review of the sponsor's historical performance and the revised expense projections, and if material risks are identified, ensure these are fully and clearly disclosed in the offering documents, potentially adjusting the offering terms or recommending the issuer revise the program structure. Explanation. This scenario presents a professional challenge because it requires a firm to balance its commitment to a firm commitment underwriting agreement with its obligation to ensure the suitability of the Direct Participation Program, DPP, for investors, particularly in the context of potential market volatility. The firm's reputation and regulatory standing are at risk if it proceeds without adequate due diligence or if it fails to uphold its fiduciary responsibilities. Careful judgment is required to navigate the pressures of the underwriting agreement while prioritizing investor protection. The correct approach involves the firm conducting thorough due diligence on the DPP, including an independent assessment of its risks, potential returns, and the sponsor's track record, even after entering into a firm commitment underwriting agreement. This approach is correct because under FINRA Rule 2111, suitability, and the general principles of firm commitment underwriting, the underwriter has a responsibility to ensure that the securities it brings to market are suitable for investors. A firm commitment means the underwriter purchases the securities from the issuer with its own capital, intending to resell them. However, this commitment does not absolve the underwriter of its due diligence obligations or its responsibility to ensure the offering is suitable for the intended investors. The firm must be able to demonstrate that it has taken reasonable steps to verify the information provided by the issuer and to assess the program's viability and risks. An incorrect approach would be to solely rely on the issuer's representations and the fact that the firm has entered into a firm commitment agreement as sufficient justification to proceed with the offering. This fails to meet the due diligence requirements inherent in underwriting and the suitability obligations to investors. The firm commitment is a financial arrangement, not a waiver of regulatory responsibilities. Another incorrect approach would be to proceed with the offering, but to significantly downplay or omit any identified risks in the offering documents to facilitate a quicker sale. This directly violates the anti-fraud provisions of securities laws and FINRA rules, which require full and fair disclosure of all material risks. A further incorrect approach would be to withdraw from the firm commitment agreement solely due to a slight downturn in the broader market, without a specific, material adverse finding related to the DPP itself. While market conditions are a factor, a firm commitment implies a higher level of certainty and risk absorption by the underwriter. Abrupt withdrawal without a valid, DPP-specific reason could lead to contractual disputes and reputational damage. But more importantly, it might indicate a failure to adequately assess the DPP's resilience to market fluctuations during the initial due diligence phase. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves a multi-stage due diligence process that begins before a firm commitment is made and continues through the offering. Key steps include understanding the issuer and sponsor, evaluating the program's structure and economics, assessing market conditions and investor demand, and ensuring all disclosures are accurate and complete. If significant adverse information arises during or after the commitment, the firm must have a clear protocol for re-evaluating the offering's suitability and its ability to proceed ethically and legally. Question 20. System analysis indicates that a principal in Ontario is reviewing a direct participation program, DPP, offering for potential clients. The DPP prospectus highlights potential tax deductions and projected returns. The principal needs to communicate the key financial aspects to prospective investors. If the DPP structure involves limitations on the deductibility of losses due to passive activity rules and at-risk limitation, and the prospectus clearly details these, what is the most appropriate approach for the principal to take when discussing the investment's tax benefits and potential for capital loss? Option A. Provide a general overview of the tax advantages without delving into the specific limitations mentioned in the prospectus, focusing instead on the projected upside. Option B. Thoroughly review the DPP's offering documents, specifically the sections detailing tax implications and the potential for loss of invested capital, and ensure all communications accurately reflect this information. Option C. Emphasize the immediate tax deduction benefits to potential investors, as this is a primary attraction of the DPP, and mention that losses are possible but not a primary concern. Option D. Advise investors that the tax benefits are guaranteed and that the risk of losing their initial investment is minimal, as the prospectus is a formality. The correct answer is B. Thoroughly review the DPP's offering documents, specifically the sections detailing tax implications and the potential for loss of invested capital, and ensure all communications accurately reflect this information. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent complexity of direct participation programs, DPP, and the critical need for investors to understand the financial implications before committing capital. The principal's responsibility is to ensure that potential investors receive accurate and complete information, particularly regarding the tax implications and the potential for capital loss, as outlined in the prospectus. Misrepresenting or omitting key financial details can lead to significant investor harm and regulatory sanctions. Correct approach analysis. The best professional practice involves a thorough review of the DPP's offering documents, specifically focusing on the tax implications and the potential for loss of invested capital as detailed in the prospectus. This approach aligns with the principles of fair dealing and investor protection mandated by securities regulations in Ontario. The prospectus is the primary disclosure document, and its contents regarding tax treatment and risk factors are paramount. A principal must ensure that any communication or advice provided to potential investors accurately reflects this information, thereby upholding their fiduciary duty and compliance obligations. Incorrect approaches analysis. Communicating that the DPP offers a guaranteed tax deduction without cross-referencing the specific limitations and conditions outlined in the prospectus is a regulatory failure. Tax benefits in DPPs are often subject to specific rules and can be clawed back or limited, and presenting them as absolute guarantees without qualification misleads investors about the certainty of the tax advantage. Focusing solely on the projected returns and downplaying the risk of capital loss, even if the prospectus mentions risks, constitutes a failure to provide a balanced and complete picture. Securities regulations require full and fair disclosure of all material risks, and minimizing or omitting discussion of potential capital loss is a direct violation of this principle. Providing a simplified explanation of the tax benefits that omits the details regarding the passive activity loss rules and at-risk limitations, as detailed in the prospectus, is also a significant regulatory failure. These rules are crucial for understanding the actual deductibility of losses and the extent to which an investor can benefit from tax deductions, and their omission creates a misleading impression of the investment's tax advantages. Professional reasoning. Professionals must adopt a systematic approach when evaluating DPP offerings. This involves 1. Prioritizing the prospectus as the definitive source of information. 2. Thoroughly analyzing all financial projections, tax implications, and risk disclosures within the prospectus. 3. Ensuring all communications with potential investors are consistent with and supported by the prospectus. 4. Actively seeking clarification on any ambiguities or complex aspects of the offering. 5. Maintaining a commitment to transparency and full disclosure, even when it might make an investment less appealing.